All right, everyone, let's talk about the Nanhua Futures IPO. This is a big one, a major name in the futures world. But the real question is, should you put your money in it? We're going to dive deep into their numbers and see if this is a real opportunity or maybe, just maybe, something you should steer clear of. So, check this out. We've got a #1 ranked futures broker going public. I mean, on the surface, that sounds like a total no-brainer, right? A definite buy. They're at the top of their game in China based on revenue. But you and I both know it's never that simple. The headline is one thing, but the real story, that's always hidden in the details. So, let's go find it. Okay, first up, the pitch. Let's see what story Nanhua is selling to investors, because every IPO has one. And their story is actually pretty clever. They're calling themselves the cross-border ferrymen. Think about that. It's a great image, right? They're the ones helping money travel safely between China and the rest of the world. With everyone talking about global investing, positioning yourself as the bridge, that's a really compelling story to tell. And if you look at their business lines, it seems to fit the story perfectly. Almost half their revenue comes from overseas financial services, which is their big thing. Then you've got your standard domestic brokerage, some risk management stuff, and a bit of wealth management. Looks good, right? Diversified, global, but, this is just the surface. Now we get to the fun part. Let's start digging. All right, enough with the story. Let's crack open the books and look at the real numbers. This is where things start to get interesting. Okay, so the first thing that jumps out at you is this huge revenue number. It looks incredible. But spoiler alert, it's kind of an illusion. Here's how it works. In their risk management business, if they help a client buy, say, $1 million worth of steel, they get to count that entire $1 million as their own revenue. But the profit they actually make on that deal, it's tiny, maybe 1 or 2%. So yeah, the revenue looks massive, but it's not what you think it is. There's actually a perfect saying for this. All flow, no dough. It means they've got tons of money passing through their hands, which makes the revenue number look amazing, but they're not actually keeping much of it. It's a classic case of a business that looks way bigger than its actual profitability. So that begs the obvious question, right? If that giant revenue number is mostly hot air, where is the real money coming from? What's actually driving their profits? Well, let's follow the trail. And here we go. We found the hidden engine of this company, and trust me, it's not what you'd expect. It has nothing to do with being a ferryman. It's something way more passive and a whole lot riskier. Just look at this chart. It tells you everything you need to know. Over half, 50.3% of their income comes from net interest. So what's that? Well, it's not from commissions. It's the interest they earn on the huge piles of cash their clients have to deposit as margin. They just take that cash, park it in a bank, especially in places like the US where interest rates are high, and collect the interest. Honestly, they're acting more like a bank than a futures broker.
And at the same time, look what's happening to their actual brokerage business. It's getting absolutely hammered. The commissions they can charge in China are in a nosedive. We're talking more than a 50% drop in just a couple of years. Why? Because everyone's in a price war. That part of their business is basically becoming worthless.
So let's just call it what it is. This is not really a futures company anymore. It's a bet on what the US Federal Reserve is going to do. Think about it. If the Fed starts cutting interest rates, their main source of profit gets wiped out. Just like that. So if you buy this IPO, you're not investing in a broker. You're gambling on US monetary policy. That's a totally different game.
Okay, so given this massive risk, you've got to ask, who's running the show? Who's in charge here? Let's look at the governance. And this is where it gets a little weird. The people in control are not some big financial firm. It's Hengdian Group. The company that runs Hengdian World Studios, the Hollywood of the East. Yeah, a movie studio company is running this futures brokerage. This is what we call industrial capital running finance. And that can create some pretty interesting conflicts. And if you look at their board, you can see exactly what I mean. Take a look. The board is basically stacked with people from the parent company Hengdian. 4 out of the 5 non-executive directors are from there. And the so-called independent directors, they're mostly academics, not people from the futures industry. So you have to wonder, who are they really working for? The shareholders of Nanhua or the parent movie studio? That's a big red flag for me. Okay, last piece of the puzzle, the price. Is this thing at least cheap? Let's talk valuation.
So here's the deal. Nanhua already trades in mainland China. Those are called A shares. This IPO is for H shares, which trade in Hong Kong. Now, normally, H shares are way cheaper. Look at their competitor, Hongye Futures. Their Hong Kong shares are almost 70% cheaper than their mainland shares. That's a huge discount. Now look at Nanhua. They're only offering at best a 33% discount. At the high end of their price range, it's barely a discount at all. It's just not a good deal. It's too expensive compared to its peers.
Okay, so we've been through the pitch, the financials, the governance, and the price. We've seen it all. So let's put it all together. What's the final verdict? Are we buying or not? And for me, it's an easy one. It's a hard pass. I am absolutely not subscribing to this IPO.
And let's just quickly recap why. First, their main profit source is totally dependent on high interest rates, which is a huge gamble. Second, their actual business, the domestic brokerage, is getting destroyed by price wars. Third, the IPO price is just too high. There's no discount, no margin for error. And finally, the governance situation with the movie studio parent company, it just doesn't feel right. When you add it all up, the risk is way too high for the potential reward. So I'll leave you with this question to think about. When a company makes more money from global interest rates than from its own actual business, are you really an investor in that company, or are you just a gambler betting on what the Fed will do next? For me, that's why I'm staying on the sidelines for this one. It's a gamble I'm not willing to take.